Welcome back to our brand new segment, our weekly review. Here we're going to review the big economic reports that occurred this past week. We're also going to talk about the Fed funds futures. When will the Fed cut rates? And we're also going to talk about what we're watching next week. Now, this past week, U.S. construction spending rises for the 11th month in a row. This is reported on MarketWatch. Construction spending in the manufacturing sector in particular rose 59%. We can see the number of different subsectors within this report. Manufacturing is the strongest. Although manufacturing is the strongest sector within construction spending, the pace of manufacturing spending is slowing. Here we can see this is a year-over-year percentage change. Manufacturing is up 59%. However, when we put this in perspective, manufacturing is actually at its weakest point we've seen in quite a long time. This 59% is actually a bad number. Now, the good news is construction spending in the residential sector is in fact improving. We can see here residential construction on a year-over-year basis up 4%. That's good news. It continues to make higher highs. The bad news, construction spending in the lodging and commercial sectors continues to decline. Here we can see on a year-over-year basis, lodging only up 5%, continuing its trend to the downside. Also, commercial construction, year-over-year basis, up only 4%, the lowest low we've seen in quite a long time. Reported on CNBC, the Job Openings and Labor Turnover Survey. This is known as the JOLTS report. Job openings nudged down in November, down to the lowest in more than 2 years. Now, total non-farm job openings, this is reported in thousands, was only at 8.79 million. This is the current reports. A continued trend to the downside to be certain. Manufacturing in the non-durable goods sector, it's down 18% on a month-over-month basis. 18% is actually the lowest sector within this report. That's non-durable goods. Those are goods manufactured that are intended to be used in less than 5 years. Now, the manufacturing, the non-durable goods sector on a year-over-year basis, 47% to the downside. Certainly, this is the worst number we've seen from the entire report as well. Some reason for hope, though. The construction sector within the JOLTS report is most closely correlated to the stock markets. The reason why that's important is because we see here, and is taking into consideration 3 years of data, we have a 56% correlation between the construction segment of the JOLTS report and the S&P 500. Here we can see the construction sector as it moves down. The green line, the S&P 500, also tends to move down. Conversely, when one goes up, the other tends to follow. So given that the construction sector of the JOLTS report has seen the highest highs in about a year now, that is encouraging news for the stock markets. Now at CNBC, the ADP National Employment Report tells us exactly this. Private payrolls added 164,000 in December, beating expectations. Here we can see 164,000. Well, that's an improvement certainly from the prior month's report. However, when we take a look at this, we see the ADP has remained below 180,000 since July of last year. Not too encouraging. We see strength in the construction sector, but weakness in the manufacturing sector. The manufacturing sector is a problem. We're talking about this in several different measures. For example, on a month-over-month basis, we see in ADP, manufacturing down 0.1%. Conversely, construction month-over-month up 0.31%. Year-over-year, manufacturing down 1.6%. Construction up 4.9%. On a year-over-year basis, we see manufacturing has declined while construction improves. The reason why we mention this is because when we consider our own investment portfolios, we should always try to align our investments with what seems to be working in the economy. And we can see here over time, the construction sector continues to rise as manufacturing continues to decline. In fact, these sectors seem to be moving further away from each other. CNBC reports non farm payrolls. U.S. payrolls increased by a 216,000 in December, much better than expected. Unfortunately, when we look at this on a seasonal basis, on a year over year basis, non farm payroll has declined for almost 2 years straight. The current report down 10% from the prior year, this time last year. The unemployment rate held steady at 3.7% compared to estimates of actually rising to 3.8%. On the surface, that seems good. We want unemployment to stay low. However, we can see on a year over year basis, the unemployment rate has increased steadily since August of last year, up 5.7% from this time last year. Average hourly earnings rose 0.4% month over month, 4.1% year over year. Average hourly earnings is actually a sign of hope. To be certain, it has reversed its downtrend. That's good news. We want average hourly earnings to go up. The labor force participation rate fell to 62.5%. That's bad news. It's the lowest level since February. It's down 676,000 on a month over month basis. The labor force participation rate is at the lowest low we've seen going back to February of last year. On a year over year basis, it also marks the slowest rate of increase at 0.3%. That's the worst number we've seen in about a year or so as well. Now, within the non farm payroll report, we have the private sector, green bars. The blue bars represent the goods, and red represents services. Non farm payroll private down, I should say, 29%. That's year over year. Blue, non farm payroll goods down 39%, services down 4%. In particular, notice non farm payroll goods in blue. That marks a decline from the prior month. That's a deterioration where the other sectors have actually improved. CNBC reports a jobs report could fuel the notion that the Fed may not cut rates as much as the market expects. Here we see in the March meeting, a 67% chance the Federal Reserve will cut rates. There's only a 6.7% chance they'll cut rates in the January meeting. Almost no reason for concern that they're going to cut rates in this meeting coming up. But putting this in perspective, the red bars show us the chances in the next meeting that the Federal Reserve will keep rates unchanged at 525 to 550. The green bars show us the chances that the Fed will cut rates. What we're seeing since the beginning of the year, and this is important, is a divergence. There's a greater chance since the beginning of the year that the Fed will not cut rates in a January meeting. Now, there's a very low probability, of course, that they would cut rates at all, but the change in the tempo, I think, should be noted. Now, we see here, for example, next week we have wholesale inventories, consumer price index, that's CPI, producer price index, PPI. In particular, the inflation reports, the CPI and PPI, are very important to watch. And we want to see how the Fed funds futures move in response to those reports. Because what we've seen since the beginning of the year is that the stock market has been on shaky ground, while the Fed funds futures indicate a lesser of a chance that the Fed will cut rates. So when there's a less chance that the Fed will cut rates, the stock market doesn't like that. Now, if you haven't already, please see our brand new Twitter channel, Just the Data. It's our daily technical trading journal where we follow major financial markets. And the way we read this is as follows. Take a look at the NASDAQ, for example. On a daily range, it shows us on Friday we closed at 31%. That means you take the low and the high of Friday, we only closed up 31% off the bottom. If this number was above 50%, it means the NASDAQ closed relatively strong. Now, on a 5-day basis, over the past 5 trading days, the NASDAQ closed only 7% off the bottom. We've seen a lot of weakness in the NASDAQ. Now, in particular, we're watching a specific theme currently, the counter trend theme. And we'd ask you, let us know what you think. Is this the beginning of a market reversal or just a technical pullback? In particular, the green bars, 10-year U.S. Treasury, it was moving steadily to the downside In anticipation, the Federal Reserve is going to cut rates. It was below its 20-day moving average. That's the red line. However, lately, over the past couple days, since the beginning of the year, we've seen a reversal back to the upside. Is this a technical reversal or a technical pullback, we should say, or the beginning of a market reversal? We could also look at crude oil, which was moving steadily to the downside, now appears to have reversed course and is above its own respective 20-day moving average. We can consider the VIX, the volatility index, which typically goes up when stocks go down. That appears to have reversed course also. And then the NASDAQ, one of the weakest of the equity markets, which was quite strong until recently. But as the stock market, the other stock markets, as the VIX, as crude oil and the bond markets have reversed, so has the NASDAQ. So again, we'd ask you, is this just a technical pullback or the beginning of a full market reversal? So if you haven't already, please visit our Twitter page. Just the data we post daily market ideas, trading ideas such as the ones we've talked about today, and we'll continue to update that with very interesting stuff over time. So if you haven't already, please visit us there, and we thank you for joining us. We look forward to seeing you back soon.